All right, gang, let's get started. First, the disclosure here. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. I got a lot less swings on. Market broke down, right? So I'm out of Walmart, I'm out of Baba, I'm out of Roblox. Even though Roblox is like the strongest tech name on the board today. Um, I'm out of a bunch of stuff. Size down. The market environment changed. Okay. So with that said, let me bring up my light speed here. Okay, so we're experiencing some tech issues here. First of all, for me personally, um, I'm in Idaho this week, so I'm out Thursday, Friday again this week, and I'm just operating a little bit handicapped today because I'm literally just on a laptop and I've got one screen, so I'm trying to use the T3 Live VTF app, which is a pretty cool app actually. It works decently well here. To be able to read your guys' comments, since I need to share pretty much my entire screen here for the VTF itself, and I've only got one screen. Usually when I'm remote, I've got a really nice setup with its pretty sick gaming computer and a few big screen monitors. And when I'm at the office, it's also a pretty good computer. The monitors aren't as good, but I got six of them, so I got a lot more flexibility. And then to top it all off, this thing that happened with Google today. What did Google stock do? I'm sure it got smoked like everything else. Oh, is it really that much off lows? Um, this thing with Google being down or something like that for a lot of the people in the country or globally or something that brought down Facebook, it brought down Instagram, it seemed to have selectively brought down the VTF for a lot of people. So anyone who's in the office in New York, like Pat or Josh, they don't have their VTF access. So Pat's supposed to be my backup here in case I got technology issues, but he's having his technology issues of his own. So we're just going to push through here today as best we can. It's obviously an important trading session today, so we can't not do an afternoon meeting. So I guess with that said, let's jump into things here a little bit. SPYs closed down 1.25%. Qs 2%. IWM 0.9%. So definitely a bloodbath out there. Definitely a bloodbath. I mean, look, this market changed. It started grinding lower in early September. Then we had that big gap down. I remember this was a Monday, September 20th. We filled that gap all the way back up. Things were looking okay. The Fed had their meeting, the Fed minutes meeting, and that was on this day. That was on the 22nd. We initially upticked that day, and then we traded down massively for 4 days. I remember finding it interesting though that the market wasn't breaking down super hard into this initial move, and it only seemed like the market had started to really take notice of this down move when the TLT actually bottomed out, when interest rates actually got to their high point. I guess technically TLT here is building out what I would call a bearish consolidation, which is a little bit different than a bear flag. Um, it's a bearish consolidation, and I can get into the differences in what a bear flag is versus a bear flag consolidation if you guys want. But as the ADMA is catching up to the highs of this bear flag consolidation, it means that you could potentially see lower price action. But the thing that's most interesting to me is, again, now we've got 4 or 5 days of sideways price action here, but it seems like in the realm of equities that interest rate sensitive movements are occurring more than anything else. So in some ways, it almost seems like a delayed reaction to the rising interest rates post September Fed meeting. Especially today, man. Some of these stocks. So what's strong? XLE is strong, right? Energy is strong. Materials, I think these daily charts of some of these material names are not looking great, but still, U.S. Steel managed to kind of be green today. Financials still, but that's better than the market, and the XLF was green for a period of time, and this daily chart in the XLF looks fine. But then you look at like tech. Tech is just getting absolutely destroyed. The Qs have been consistently relatively weak compared to like the IWM really since mid-August now. This IWM chart looks fine. Look at it, inside day on the IWM today. Like, all right, fine. It's down a decent amount on a percentage basis, but you look at this daily chart on the IWM, it doesn't look like anything changed. You look at the SPYs, you look at the Qs, and they look downright bearish. And the only thing that we got to pay attention to is we want to make sure that we're not shorting a market when it's down too much, right? When it's too extended to the downside. But the SPYs and the Qs look downright bearish. Everyone's talking about the 200-day. So 200-day for the SPYs is still $15 away. It's my yellow line there. It's at 413. Qs are at 340. I don't like when everyone talks about something because from my experience in trading, when everyone is talking about something or everyone's looking for something, it actually usually does not occur. But all the same, SPYs and Qs are basically looking outright bearish. Apple is officially in a market correction. Apple from its highs to lows now with today is down about 11%. So you've got Apple officially in a market correction. I always start to pay attention. I mentioned this on the VTF today. I always start to really pay attention to percentages. I'm assuming that the VTF is still running. I'm not seeing a new comment here since 211, which isn't 411, which is not a good thing. But I always start paying attention to percentage retracements because we know, I forget what the exact statistic is, but you get a technical market correction, which is 10% down move on average, like 1.5, 1.6 times a year. I forget exactly what that statistic is. So seeing, a downside correction in the S&P is not that surprising. Seeing Apple down more than 10% and actually having a correction, it's not that surprising, especially when you consider the run that we've had since the coronavirus lows. So we just want to be paying attention to that and thinking about it with a little bit of perspective, right? I think at this point, the NASDAQ is down about 8% or so off of its highs. The S&P is down about 6% or so off of its highs. So the markets themselves are not even in correction territory, even though Apple obviously is. And again, the stocks that really seem to be getting the brunt of this are the companies that don't make money but are not like mega tech cap stocks either. Because, and I've been saying this for years, if all of a sudden you run into a market environment where money's not free, and we're still honestly not in that environment right now. I mean, what's the 10-year Treasury rate at? What's the Fed funds rate at? It's just markets are starting to anticipate, because markets are a forward-looking mechanism, that money is not going to remain free, and they're doing that based on Jerome Powell's latest comments at the most recent Fed meeting. So you're seeing some of these stocks today, man, and it's interesting again because the TLT had no movement these last 5 days, but like the list of stocks that I call like the real speculative names of the universe, like a Jumai, which is down 5% today, like a Palantir, which is down 5% today, and look at this bloodbath in Palantir over the course of these 6 days here. Just, I mean, look at just destruction. 28.40 to $23 basically in 5 trading sessions. Wish, right? Which Wish was one of those speculative type names. Wish down over 9% today, even though, and these stocks were already destroyed even prior to today and prior to these recent moves. The last real low that we saw for a lot of them was back here in May, where they got strong bounces, and many of these have now totally broken those May lows. An INSG is below its May lows. A Sumo is below its May lows. You had the support here at $16 that I was looking at a few days ago. So these more kind of speculative interest rate type names are just getting absolutely destroyed. And it makes sense. And I really have no idea where those types of stocks in air quotes belong, right? Because you could look at, I don't know, in some ways you could almost look at the dot-com bubble, though I do think that the dot-com bubble was very different because most of those stocks didn't even have revenue. At least a lot of these companies have revenue. They might be able to keep themselves together in some way if they start dramatically cutting costs. But the whole idea with a lot of these companies is that they are just spending money and spending money and spending money because it's free, so they can grow a user base that's big enough where it becomes a sustainable mechanism, right? That's been the Uber model. Uber, which has actually held up really well since that news came out on September 21st. It's the Uber model. It's what Amazon did forever, right? So that's what all those companies are doing. But now all of a sudden, your money is potentially not going to be free in the future anymore, and it seems like the market's discounting that. But again, the interesting thing to me about it is that we're seeing this occur now on a day when the TLT, now for 5 days in a row, has actually stabilized. So again, where do these companies belong as far as their price goes? Well, can you really value a company that um, doesn't have earnings or has never had earnings? It's difficult. So that's why our technicals are so important, and a lot of these companies have completely broken down. It's a two-way market. I think it's important that we recognize that as market environment has changed. So first of all, shout out to a lot of you guys for doing some short selling on the indices this morning. I was a little nervous to do short selling because, if you look at the Qs here as just an example, you've got Friday giving you a hammer low with a tail, and the market still being a little bit extended, and then we're having a gap down. So based on the pure book of technical analysis, even in a market that might now, you could argue, is trending lower, when you have a hammer on extension and a gap down, you're actually, most of the time going to be better off being a buyer off the open than you will be a seller. But very quickly today, we were able to tell that wasn't accurate. Okay, fine. This opening weakness here, the first 15 minutes, is absolutely gross. That in and of itself is telling you that something's wrong. But you got to keep in mind how much the market had actually bounced from its pre-market low. Right, by the time we actually opened up here today at 358.50, we had already bounced pretty significantly off the pre-market low. So we're selling off here initially off the open. Okay, fine. We're working our way towards those pre-market lows. We're extending on every time frame. We hadn't broken yesterday's low yet. So this pivot point here at like 945, 950, depending upon which index you're looking at, I think that that's actually a great opportunity to be trying longs, because you have a market that's extended to the downside in every time frame, but you're still above yesterday's hammer tail low. So you try your longs here off that extension. You try your longs here off that pivot. When this pivot breaks here, though, at 10 a.m., you know it's not right. And if that wasn't enough for you, the break of yesterday's low is when you definitely know it wasn't right. Because if you guys watch my candlestick class, what I talk about is this type of candle gives you like a 50% probability, in excess of a 50% probability of getting a snapback to the space between the 8 and 21 EMA, provided it's confirmed by volume, which this really was not confirmed by volume on Friday. That was one of my concerns with it. A second concern was that it wasn't super extended here on the small time frame. I mean, we're not even that super extended, I think, even as of today's close, which is also something that's a little bit scary to me. But once you break this type of tail low, usually it's a signal that you're going to be seeing, significantly more downside price action. So shout out to a lot of you guys here on the VTF who not only didn't get caught being long stuff, you guys were coming in shorting SPYs, Qs, TQQ. I didn't really participate in that trade with you guys, but you were all calling it out on the virtual trading floor. It was a great trade in and of itself, let alone if it was an actual hedge on swing longs or anything like that might actually still be intact for you. I'm seeing Diego's message in here on the tech bubble. It got crazy when Greenspan lowered rates due to fears of Y2K, and now they're talking about the Fed actually jacking rates up. Yeah, so it's definitely really interesting price action. That's kind of where our markets are. Markets are looking bearish. SPYs and Qs look bearish. IWM looks neutral. So I think it's a two-way market. We want to continue to measure extension. We want to continue to measure relative strength and relative weakness. And we want to be able to focus on names that are in play. And honestly, even by doing that, we still had some pretty good call-outs and some pretty good trades today. Let me check. I'm using so many devices right now to make up for my lack of screens. Checking my iPad here. So some of the names that we spoke about in the morning meeting today, we did speak about Tesla. Tesla ended up being pretty weak and actually having a failed breakout today. I think you can attribute a lot of that to the market. Overall, Tesla's been really solid. It had good news this morning, so that was one of the things. A combination of positive news and a bullish pattern definitely had Tesla on the radar. There's been several good technical trades here on the way up, though. You would think that a company like Tesla would be like on the front line of companies that are getting hit by a fear of rising interest rates, like all the other companies that are reliant on free cash in order to continue. But we don't want to be fighting the technicals of the market either. And the technicals of the market for Tesla have remained really bullish. We saw that bullish option flow that was coming in last week in a pretty big way. All the same, I think the best trade here in this Tesla was on the break of this inside five. So as a lot of you guys know, and I know there's some new people, so I can go over it kind of real briefly here. Inside bars are something that we utilize as an execution strategy for when we like other things. So what was there to like about Tesla? There was the news, the gap up, the daily chart, the breakout on the daily chart, the fact that Tesla today was even technically a breakaway gap on its daily chart. Breakaway gaps, we're talking about this in the VTF on the last half hour of the day, they usually actually tend to lead to continuation, right? Continuation of the direction in the gap. So when you see that, there's volatility here for the first 10 minutes, that's enabling this ADMA to catch up. So it's acting as kind of a time correction. And then you get this inside five and up. This is exactly the break of this bar where I would want to execute this. You cannot trade, I just want to reemphasize this. You cannot trade every inside candle that you see. If you trade every inside candle that you see, it's going to be a losing strategy for you in the long run. But we can utilize inside bars on different time frames as an execution strategy for when we like other things. Whether it's a 5-minute chart or a daily chart or what have you. So Tesla there was definitely an interesting trading vehicle today. I think it's a difficult trading vehicle. I don't really like going to this too much. And then same thing. Once it broke its opening low here, which I would attribute a lot of that to market weakness. All these people who bought this morning are out of the money. Then you just need to stop yourself out and you need to get the heck out of the way. We talked about taking a look at some of these Chinese names like Alibaba because they're starting to get kind of insanely extended to the downside. JD as well but JD's been much more relatively strong. I mean, just look at the July lows here at $62 that got tested twice versus Alibaba's July low, which was all the way up here at 180. Just shows you how much stronger JD has been to Baba. It's been the better trading vehicle. All the same, I liked the idea that some guys and gals were looking at of a trade back through 140 here versus lows in Baba based off this significant volume and the extension on multiple time frames. And again, those are all the keys. I really want everyone to make note of why trades are good trades. It's not just ever enough to just look at this candlestick here and say, oh, this is a bullish bottoming hammer doji or whatever you want to call it and come in and buy it. It's everything else. It's the volume. It's the fact that if you're buying back through 140 here, that the ADMA on the 5-minute chart at that point was still at 142.67. So you have a really good risk reward here. You have volume confirmation. If you're looking at the daily chart, your daily ADMA is at 147. This easily could have led to a snapback, $247 in the daily chart, and all entirely off this candle. So you take that trade, but you got to recognize that it's a counter trend trade. So when you are dealing with a counter trend trade, they're going to tend to fail. It's just a matter of how much you can get out of them before they fail. And in this case, you didn't get too much out of it. Again, luckily, I know most people who took this trade were able to cover their risk because the bounce here was big enough. The trade here was 55 cents worth of risk back through 140. The bounce back was to 140.76, so it gave you 1.5 to 1 on that bounce. So it should be enough if you're having good game planning and good execution. And this is something I spoke about last week as well, that the key in this market environment right now, more than ever, a lot of 2020 and 2021, we were working with a very forgiving trading environment where you could make execution mistakes, you could make game planning mistakes, but the market was just so strong, it was so conducive that you could make those mistakes and kind of be okay from it. We're not in that environment anymore. We're in an environment right now where execution matters and game planning matters. You can't be taking counter trend trades and not covering your risk when the market gives you the opportunity. And if you have good execution on counter trend trades, you usually will be able to cover your risk. That's key. And then you can see what happens. In some cases, it might be like this Alibaba that gives you this bounce back and then fails. In another case, it might be a different world where this bounces better back to the ADMA. You get an initial move here to like 140, 150, or even a little bit further back to highs. It pulls back and makes a higher low. It makes new highs on the day. It fills its gap. It closes at 144, and then by tomorrow, or the day after tomorrow, it's trading at 147 to 150, and that's what makes this an excellent trade. So again, anyone who took this Alibaba trade, I know there was a few of you, just really make sure that your execution and your game plan was in place. And if it was, then I think this is a really good trade, despite the outcome. And the outcome for you should be no loss, no gain, which that's what we want. We consistently want to be able to have on our failed trades, no loss, no gain, or even better, you game planned it so well, you executed it so well that you're even able to make some money on trades that fail. So that was the Alibaba trade today. A couple other things that got called out in the VTF. One was this Roblox. I forget who it was. Somebody called out this volume coming in on this first green bar of the day here at 9:45 a.m. in Roblox and talked about it as a long. The relative strength in this thing, I don't even understand how or why this name was able to be as strong as it was today. I mean, somebody find me another tech stock, a speculative tech stock besides Tesla that was actually able to be positive today. I know IBM, I think IBM was green today, but I don't consider IBM to be as much of a speculative tech stock as like a like a Roblox. Roblox is almost more in like that Palantir type category of names, and this thing was able to be green. So that was a fantastic call out. I know Jerry here this morning actually brought a couple of names to the table that he really liked the charts of, and those were solid as well. There's CVE, and OVV. So OVV closed at highs. I mean, just great. I actually thought that the CVE was the better looking name at the open, but OVV ended up being the better one. I love this opening pattern. Again, beautiful green momentum opening candle here on great volume. In a bullish chart here, you have a bullish bull flag with this inside day at the end. The ADMA caught up. This is all perfect textbook stuff here. And you got this beautiful ignition candle followed by two inside bars in a row. So we call that a 5-minute shooter. And again, this becomes your execution. It's rest. It enables this ADMA to catch up. And then you could be buying on this fourth candle through the break of the third candle for literally 5-6 cents risk on this thing, and obviously works out pretty well. And that OVV was actually much more difficult off the open. I know Josh said that he was coming in and buying it on this candle at 9:45, and then that one worked out fantastically well also. So again, the point here is we are in a different market environment. Different does not always mean difficult, but different often is difficult because it's new, right? You get so used to trading a certain market environment, trading a certain way, and then that market environment changes, and you as a trader have to be able to adjust and change with it, and that is really difficult. And honestly, we've spoken in the past here on like why traders fail as a like a question that gets brought up sometimes, and the number one reason, I had that whole big like rave about it a few weeks ago. The number one reason why traders fail, we all know, is because of a lack of money management and risk management. That's first and foremost. Secondarily to that is sometimes the reward side of it. It's lesser. It's usually the risk thing for most people, but every once in a while you get a person who has really good risk management skills, but they just can't put together the reward. As soon as they see that they're starting to make money, they pull out from it. Those are the number one reasons why traders fail. The number one reason why experienced to semi-experienced traders fail is different. The number one reason, based on my career, on why I've seen traders who were really good for periods of time then fall out of the business is because of a change in market environment. Because you might have a certain set of strategies that are just paying you. They're paying you so consistently for a month, a quarter, a year. And then all of a sudden that market environment changes in such a way where those strategies are not working for you in the same way. And if those strategies are not working for you in the same way, you have to be able to change and adjust. But that's very difficult, even for traders who have been successful, to do that. And I know even for myself, the biggest slump I ever had in my trading career was the first time I dealt with a major market environment change. And it was just like that. I had strategies that worked for me. They paid me really consistently. And guess what? All of a sudden, they didn't work anymore. So it's really important that we're constantly paying attention to the big picture market, and we're paying attention to this environment, and that we're adjusting as the market changes, because we had this certain environment here for so long, you know, definitely since November 2020, arguably since the March low, where this market is just working its way higher and every dip is buyable, and you kind of always want it to err to the side of the longs. And we have to recognize that this market environment has changed. Initially we broke the uptrend line here. Okay, fine. Potentially still not totally broken, but now at this point with these lows breaking, it's a different market environment, and it's a two-way market environment. You can be long stuff, you can be short stuff, and you can make money on both sides. And that's all I got for you guys today. So let me go over to the virtual trading floor and take a look at questions. Oh, so first of all, there was one question that somebody wanted me to talk about. Oh, Ford. So Ford was another decent opening trade, but it closed terrible. I know people were looking at Ford and GM this morning. We spoke about it in the morning meeting today. And good looking daily chart here. GM had some news. Ford we chatted about as a potential secondary play. And off this great looking daily chart, it gave a fantastic looking initial move on volume. And then it eventually totally failed, and it left a garbage looking trade here. And someone brought up this Ford, and I mentioned the concept of a risk reward stop. And people don't seem to entirely know what a risk reward stop is. A risk reward stop is different than just your stop loss that you have to have on for risk management purposes. It's also different than a trailing stop. A trailing stop is where you're raising your stop over time based on a set of rules. And again, my game planning class gets into my 3 rules for trailing stops in detail, so I'm not going to talk about that today. A risk reward stop is different. It's different than those. A risk reward stop is for when you have a target. You have an offer out because of a target. So let's just, and I think that the person who was trading Ford said that their target was 15. But let me start by let me make it a little more extreme example than that before we get into that. Let's say that your target, your offer in this Ford was $14.84. The high of the day today is $14.79. And it had a fantastic momentum move here for the first half hour or so of the day. We know that momentum moves make stocks extended. And we also know that those moves oftentimes begin to die out when volume maximizes. Volume maximizes almost at the top here on Ford. So if you're sitting there at $14.84 on your offer because that's your target or whatever, and you caught this big move here, but maybe your stop loss is at $14. At that point, think about your risk reward. You are risking giving the stock back 79 cents to $14 where your stop loss is to make 4 cents. Is that a good risk reward or a bad risk reward? I'm sure we can all agree that risking 80 cents to make 4 cents is not the risk reward that we're looking for in our trading. Now, if you're implementing a trailing stop system on this trade, well, then that's fine. It's fine to potentially give stock all the way back to $14 because you're trying, the whole purpose of a trailing stop is to, especially when you're with trend, like you are on every time frame here with Ford, the idea behind that trailing stop is that you're looking to maximize your reward and keep that reward unlimited. So if you gave Ford back, this entire move today, or you give it all the way back to $14 because you're implementing a trailing stop system, and you might still have Ford when it's at 20 or 25, I got no problem with that. But I do have a problem of I have a price target for 25% of my position at $14.84, so I'm offered there, and I'm going to give this thing back 80 cents to make 4. That's no good. So that's where we have this concept of what I call a risk-reward stop loss. A risk-reward stop loss is really not based on technicals, and I usually don't like that, right? I tell you guys all the time, I'm always trying to make my decisions based on technicals. I trail my stops based on technicals. I put in my initial stop losses based on technicals. I don't ever just use a random percentage or anything like that. But this is the one case where it actually does become a little bit more. I try not to make it random as much as I can help it, but it does become a little bit more kind of random. So a pure risk reward stop would basically say to you, I'm trying to make an additional 4 cents, so my stop loss is 4 cents down. Or what's the high 79, and we're saying you're offered at 50 at 84, so you're trying to make an additional 5 cents, so your stop loss is just 5 cents lower. So your stop loss is just at $14.74. The idea here is, all right, I still want to get filled on your offer because that was your target. It's your target for a reason, I assume. But I'm not giving this thing back 80 cents in order to make 5 cents. But I am willing to give it back 5 cents in order to make 5 cents. Maybe you're willing to give it back 8 or 10 cents in order to make that 5 cents because that's your target and you're so much of the money. Fine. That's what a risk reward stop is. Don't give a stock back 80 cents to make an additional 4. Give a stock back 5 cents to make an additional 4 or 5. That's a risk reward stop. And it's not really based on technicals, but I will try to have like, and there's nothing really too great here, but the low of this bar is 68, right? So all right, so maybe I just put my stop in at 67. That violates my trailing stop rules. Based on my trailing stop rules, I cannot put a stop loss here at 67 cents. But based on the concept of risk reward, I can't give this thing back 80 cents to make 4. All right, fine. This last little low of this bar is at 68. How about I give it 10 cents to see if I can make that extra 4? That's what a risk reward stop is. And it's really should only be used when you have an offer out because it's like a target price that you have on a percentage of your position or whatever it is. And again, you don't want to be giving it all the way back just to make that little bit more. So that is what a risk reward stop is. Let me go back to my phone here so I can take a look at the VTF, see what other questions we got. Mike asking about thoughts on gold. Gold has been such garbage. Let's take a look. Let's take a look and see if it's improved. So it has improved, and I see the potential. Yeah, it's a little sloppy. I kind of see the W pattern that you're pointing to here. It's a little bit sloppy. Technically, you'd only have confirmation above 171. This gold chart does definitely look more productive after today. I am in no rush to get involved in gold. The gold chart has been so broken here for so long. I mean, the gold chart's been broken really ever since it put in highs back in 2020. And if not at highs, definitely by the time it lost this support back in September 2020, literally a year ago, the chart's been broken ever since. And I was able to catch a lot of this initial ride up off lows in gold. It was a really good trade. I did it through the gold miners. And since then, I've tried it a couple of times, some of the gold, ETFs and some of the gold miners, but with very minimal success. And I've mainly stayed away from it just because this chart's just been so broken. Show me gold getting back above this area between 170 and 172. And then I'll be looking at something that I like a lot more. And I don't need to be first on this and trying to pick bottoms in a really sloppy chart. So yeah, definitely looking a little bit more productive after today in GLD, but nothing that I'm getting overly excited about at this point. Isn't the VIE structure illegal in China? I don't know what VIE stands for, Stefan. You really own a stock that has a revenue stream, but not ownership plus government in China. I think I understand what you're talking about. You're talking about it just being an ADR, right? Pat saying that gold has a 10-year cup and handle. Yeah, I'm not entirely sure, Stefan, but probably what you're saying sounds right. I gotta look into it more. Chris saying that net finished positive. So this is probably back on my comment on if there's any other speculative tech stocks that finish positive today. Okay, fine. Cloudflare finished positive. I'm not considering Hewlett Packard to be a speculative tech stock. Maybe a little bit more in the IBM kind of category of things here. Shane had that OVV. Yeah, OVV was a nice one today. Okay, let's take a look at GDX also, along with gold. I didn't really look. Oh my God, this GDX looks terrible though. It's bear flagging again here. Maybe it breaks out. Failed pattern comes a fast move, but this is not something I'd be counting on at this point. We really need some sort of change to come in on this, and it's just not there yet. Not that I'm seeing. Chris saying, in this change of market environment, is it better to err to the short side? I don't necessarily think so. I think it's really a two-way market that we're looking at right now. I think you can be short and you can be long. And we want to pay attention to degrees of extension and degrees of relative strength. Also, your time frame matters. If you're talking about more of a smaller time frame, or even maybe an intermediate time frame, at this point you might actually be better off erring to the short side. If you look at a big enough time frame, well, your 200 days still rising, the market's still bullish overall. So big enough of a picture here, you still do want to be erring to the side of the longs. But again, look at the mixed message I'm telling you. Depends on your time frame. You might be better off erring to the side of the shorts. You might be better off erring to the side of the longs. What does that mean? And also, we have relative strength and we have relative weakness. If you look at the IWM, it looks totally different than the SPYs, which looks a bit different than the Qs. So for me, all of that really means a two-way market. You can definitely be short. Like someone brought up a name that IIVI or something today that got downgraded and had a big down move today. At any other point in this year, I would have zero interest in this. Or Square. Square was actually a great idea that someone brought up as a short in the morning meeting today that we discussed. For most of this year, I would have had zero interest in these stocks to the short side. But now I do. Because, for most of the year, if you're trying to short Square, okay, fine, it's a good trade in and of itself in its own void. But you're fighting the market. Now you're not fighting the market. And if anything, Square, being a tech stock, inherently makes it relatively weak. So you got a bearish chart set up in Qs that are now short time frame and medium time frame downtrending in relative weakness. Yeah, that's where you can be looking for a short. But do you really want to come in and short XLE right now? Or even that Ford, which I know failed today. You want to be shorting these patterns? You definitely don't. That's where your relative strength is. So I think the answer to your question, do you want to err to the side of the long, err to the side of the short? It's highly dependent upon what you're looking at and what your time frame is now. And that's why I characterize this as more of a two-way market environment than anything else. Thanks, Stefan. I'll take a look at that after the meeting. From Aaron here. And if anybody sees that there's questions coming in to the YouTube, usually Pat's able to copy and paste that, but I don't know if Pat's able to be here. From Aaron here, what is our best case scenario for tomorrow for an advantage? Gap up, gap down. Probably. Let me take a look at how we closed again today. Probably gap down. Yeah, we closed off lows, but not tremendously off lows. I would have loved us to close weaker today. The 427 close today with a nice few dollar gap down would have been fantastic. If we gap up, the worst case scenario I think is a small gap up tomorrow. A big enough of a gap up might be shortable. A small gap up isn't going to be enough to necessarily come in and short, and we're definitely we won't be extended, so you can't come in and buy. So I think the worst case scenario for tomorrow would be like a small gap up. A better case scenario would be a bigger gap up. A better case scenario would be a big gap down. But we'll see. One of the things that's been difficult here for September, and since this market has started to change, is every time we've wanted that weak close or a gap in a certain direction, we're really never getting it, which has been tough. Usually, sometimes the market tosses you a bone. And we also got to pay attention to seasonality. October is usually a very seasonally volatile month, and then usually year end tends to be more bullish. But right now our technicals are not giving us bullish signals, so we'll see. Jerry saying that Dix might be a short. Yeah, well, Dix has some gap fill support here around 115. So it makes me not love it as much. You could be looking for that move lower. I also would want this to set up a little bit better. Um, yeah, I guess there is an inside day today though, so you could try to be short dicks through today's low or versus today's high tomorrow, depending on how the market gaps. Caesars, yeah, Caesars does looks good. Does look good. What about MGM? MGM looks good also. What about Wynn in Vegas that have China exposure? No good. No good. Yeah, I think Caesars looks solid. Oh, another name that's at highs. Another name that has a really bullish looking chart. Inside day today, so it's set up for tomorrow. One to keep an eye on for tomorrow, for sure. Oxy and Apache, yeah, we discussed those in the morning meeting today. As you know, this is what you want to be long. You just don't want to be buying it today. Unfortunately, I was out on Friday because I think that this thing gave a beautiful setup to come in and get long on Friday based on its daily chart. And then today it gapped up so big, it's extending the daily chart. These tend to not be momentum names, even though this is where your relative strength is. This is what you want. Today was not the date to enter Oxy. And if anything, today's candle tells you that we could see excuse me, a bit of a bigger pullback in Oxy, which I actually want that. I want a little bit of a pullback in Oxy because it can reset up to the long for the long. If you're already in it from prior to today, definitely stick with your trade. Loving the strength. If you weren't in it coming into today, not the day to buy because of the extension. We'll see how it gaps tomorrow. But most likely tomorrow is not going to be the day to buy either because of today's candle. Higher volume shooting star candle usually means some sort of retracement or correction. So basically this Oxy needs time to reset up. Let's see if Apache's giving us a different signal. I like the Oxy chart better. It's cleaner. I really don't like this candle here from September 28th, this negative Maribozu. That kind of puts this name a little bit more in the penalty box than Oxy. But it pulled back to the 21 EMA, gave another higher low, so it looks okay. But breaking this high, getting back above 2350, should prove difficult for Apache. So that kind of tells me also I don't really want to jump in and buy this name just yet. And Oxy is the one I like better, but I think it also needs a little bit more time to set up. So that was for Alan there. All right, gang. Looks like we basically covered it. I hope I'm not missing anybody's questions. Because again, I'm a little bit handicapped here as far as the technology goes today, and I know there's been internet issues everywhere. So I'm out here in Idaho, and it's only what time is it out here? 3 o'clock. It's gorgeous out. I'm gonna finish up some work, and I'm gonna go enjoy the landscape out here. Go hang out with Kate and Dixie, my emotional support horses that are in the backyard. All right, everybody. Have a great night. I'll see you all tomorrow.